So, what do an FBI raid, a software algorithm, and your prospective buyer's current rent payment all have in common? Well, it's a big real estate antitrust case. And good news is it has nothing to do with your commissions for a change. Well, hello out there to all you passionate podcast patrons. Welcome to the Texas Real Estate and Finance Podcast Market Update for the week of June 11th. My name is Mike Mills, and I'm your local luminary shedding light on the biggest stories in real estate that you just don't have time to read about because you are too busy helping your clients buy and sell real estate. So I'm here to update you each week on the news impacting your business so you can keep grinding it out in this real estate game that we all know and love to play. And just in case you didn't know, when I'm not dumping my brain into this microphone twice a week, I'm here to help your buyers and investors find ways to finance that diamond in the rough property that they've had their eye on for so long. My team and I specialize in those out-of-the-box situations that most lenders shy away from. We love helping people that have heard no way too many times and helping them find a way to get that home of their dreams. So if you got somebody that just can't seem to get help anywhere else, give us a call and let us see what we can do. Okay, enough about me. What do we have in store for today's episode? Well, right off the top, we've got your weekly mortgage interest rate update. Where are they now? Where are they headed? And more importantly, why? Then I'll let you know what's happening with housing inventory across the country and right here in Texas. As we head into the summer, inventory is actually beginning to climb. Unfortunately, just like the heat index. But I'll tell you where you can find the best opportunity for those good deals for your clients. I also have some news stories from around the world of real estate and finance that impact your business that you should be aware of. Government spending is up, unemployment is flat, but is it really? And what big events are happening this week that are likely to move markets? And finally, I'm going to tell you what an FBI raid, a software algorithm, and your clients' rent payments all have in common, and why it's just one more reason for your clients to find every way possible to get out of the rent race. So if you know someone on the fence about buying right now, you need to hear this story. All right, let's buckle up and tune in because we're about to take a fantastic tour around the market. So, Mike, you say, what are the rates? Well, I'm glad you asked. So according to Mortgage News Daily, as of June 10th, the average 30-year fixed conventional mortgage rate is about 7.17%. The average 30-year FHA rate is about 6.65%. The average 30-year VA rate is about 6.66%. That's a little scary number. The average 15-year conventional rate is about 6.62%, and the average jumbo rate is about 7.38%. So overall, rates are basically flat to slightly down from this time last week. And overall, last week, we saw some pretty dramatic volatility in the bond market due to higher than expected job openings reported by the BLS on Friday, because things had been trending pretty solidly in a good direction as far as lower rates are concerned, only to be flipped upside down on Friday by some BS BLS data. More on that later in the episode. But either way, we're starting to trend back into higher rate territory as we head into this week. And Wednesday is going to be another huge day for mortgage rates as the market braces for CPI inflation data for May and the Fed's June meeting. The general sentiment is that inflation will remain mostly flat, but how the Fed responds to that data and what they say at the meeting is what's going to ultimately determine where rates turn this week. The overall expectation is the Fed is not going to change rates, but they may give indications as to what they plan to do for the rest of the year. So stay tuned because this could be a big week for mortgage rates. And guys, like I've said on many times on the show before, job data is going to be so crucial to where rates go for the rest of this year. Inflation data is certainly going to play a role, and it will move markets up and down some. But the overall expectation is that inflation is going to remain pretty sticky for the foreseeable future. And if the Fed does decide to start cutting rates, at least in my opinion, it'll have less to do with inflation and more to do with the job market and unemployment. And right now, since we're in an election year, every single headline and every bit of information coming out about the economy should be subject to scrutiny. Because if headlines say that jobs are plentiful and the economy is booming, that's good for the incumbent. But if headlines say that jobs are slipping and the economy is contracting, then that's good for the party that's not in power. And with all the revisions to the data that have come out months after the initial headlines, with of course much less news coverage, it's very understandable that analysts are going to look at these reported numbers a little more closely to see what they're actually telling us about the health of the US economy, regardless of what the corporate media tells you. Because right now, most of the headlines say that the economy is awesome. However, many Americans are not experiencing that. And here's the deal. When it comes to the 2024 election and what voters say they mostly care about, it has nothing to do with all the social and cultural issues that you hear about all the time through the corporate media. And I don't need to say what they are. You guys all know it. The real main issue in the upcoming election is the same main issue that it's been for every election: the economy. In fact, a recent poll of 3,000 homeowners and renters were asked what were the important issues that would decide their vote in the presidential election in the fall. And 91% of Gen Z voters said affordable housing was their top issue, compared to 87% of millennials, 83% of Gen X, and 80% of baby boomers. Look, people vote with their wallets, and housing affordability is the most important issue in this year's election, surpassing everything else that you can think of. This is on everyone's mind, and you guys are at the front lines of this. That's why it's so important for you to stay up to date on where things are trending, so you can alert your clients when things start to shift. It's one of the best reasons to stay in front of and contact your past clients right now. And I'm here to make sure that you're up to date. So make an appointment every Tuesday to tune in and find out where things are headed, because I got your back. All right, moving on. So when it comes to housing affordability, the biggest story related to this for 2024 has been the rise in inventory. Now, if you're on Twitter or YouTube regularly, you'd think we were on the verge of a major housing crash because of all the inventory gains that we've made in 2024. Because according to them, housing is crashing, prices are falling, and sell before it's too late. I love this stuff. Probably more than I should, but I find it entertaining at the very least. So here's the thing. Inventory is rising all across the country. And if you're in real estate, this is a really good thing. Not a bad thing. Inventory growth means that there's more options for buyers, which means better opportunity for deals, which means more people being less angry about the prices of homes and willing to start shopping. You can get seller concessions, price reductions, or rate buy downs if that's your jam. It just means that there's more options for buyers. But be aware that this isn't everywhere. There are plenty of markets where inventory is still very, very tight. And there are some markets where we are finally above pre-pandemic inventory levels, which just means we're starting to crawl out of the inventory hole. It doesn't mean that we're even close to being back to even just a balanced housing market, because a balanced housing market is where we have anywhere between 5 to 7 months of inventory on hand to purchase. So in Dallas-Fort Worth right now, for example, we have about 37,000 homes for sale, which based on the rate of sales equates to about 3.5 months of supply. And our low was back in January of 2022 when we only had about 19,000 homes on the market. And back in July of 2019, we had about 40,000 homes available for sale. So we are just now starting to get back above pre-pandemic levels. And again, this doesn't mean that things are crashing. It just means that we're starting to get a little healthy again. But if you compare it to a place like Chicago, where right now there's only 11,000 homes for sale and things are still very tight, if you're living in Illinois, it's still really hard to get a home. So it all depends on where you are and what you're looking for. In the US as a whole, inventory rose from about 605,000 units last week to about 611,000 units this week. And last year at this time, we were only sitting at about 443,000 total units available. So we're making big improvements, absolutely. But again, the last time we had even somewhat of a healthy, balanced housing market was back in 2015 when we had 1.16 million units on the market. And oh, by the way, between 2015 and today, the US population has grown by more than 20 million people. So we're at 500,000 less housing units with 20 million more people. Still incredibly unhealthy, but improving. So inventory growth is good, but it doesn't mean that housing is crashing. It's like being starved and weighing like 50 pounds. And then when you finally have some food to eat and get up to maybe like 100 pounds, people start telling you that you need to go on The Biggest Loser before things get out of control. Trust me, we can still afford to gorge ourselves on housing inventory before anyone needs to start worrying about crashing. So there are deals to be had out there, but only if you're looking in the right places. But there are also plenty of places out there right now where realtors hear the term highest and best anytime they make an offer. Like good luck buying in Euless, Capel, Allen, Grapevine, Pearland, The Colony, and Louisville in North Texas. These are some of the most competitive markets in the state right now. But when you get into some of the bigger metro areas around Texas, we're growing in inventory. Houston, San Antonio, Dallas proper, Austin, Fort Worth, and Arlington as of May 2024 have the most available inventory that they've seen in over 4 years. So is this trend going to continue, and should your clients wait to see if prices come down even more? Well, honestly, maybe. But like anything else, when the market flips, it's going to happen very fast, and it will be driven by rates. And when that August 17th deadline hits and sellers are going to be less and less inclined to pay buyer agent commissions, if rates do trend down, the deals that you can find right now probably aren't going to be there. So time will tell. But encourage your clients to look and see what's out there, because the perfect home could be coming their way and there could be a great deal attached to it, even if they aren't quite ready. But if there is a deal to be had, this is the best time to be looking for it since the pandemic, depending on where you look. And as always, I will be here to let you know when that market does start to turn. So stay tuned. All right, now let's touch on a few headlines around the economy that could impact your buyers and sellers. And you should be aware so you can know exactly what's going on and how it might affect someone's decision to buy or sell their home. Just some quick hits to keep you in the loop and a few upcoming events that you're going to want to pay attention to. So last week, it was reported that the US economy added 272,000 jobs, coming in much stronger than the market anticipated of about 185,000 jobs. But unemployment rose from 3.9% to 4%. And markets moved very heavily in a bad direction on this news. Why, you ask? Because it shows that the economy is still strong and would lead people to believe it would push a Fed rate cut out even further into the future. But how could we add jobs and have the unemployment rate go up? Well, here's why some of these numbers still look a little suspicious. So almost all of the jobs, 231,000 to be exact, came from what's called the birth-death model, which only estimates the number of jobs added by small businesses using a formulaic calculation and not actual job numbers. However, when you look at the household survey, which actually polls Americans to ask them about their job situation, there was an estimated 408,000 job losses. And that's where your unemployment number comes from, which is why it went up. But of that 408,000 people, 250,000 people said that they left the job market altogether. And so those numbers are completely factored out of the unemployment rate because those people aren't technically looking for a job. So what that means is that the unemployment rate could have been even higher if that 250,000 people didn't just give up on the job market altogether. And oh, by the way, you can for sure expect some revisions to that job gain number in the coming months. But all that matters right now is that headline said we're doing awesome. So based on all that, what do you think? Now, in some local Texas news, TXSE Group, backed by BlackRock and Citadel Securities, plans to launch the Texas Stock Exchange in Dallas, going up against established New York-centric exchanges in a bid to attract global companies. Now, right now, the exchange has raised about $120 million and plans to file registration documents with the U.S. Securities and Exchange Commission to start operating as a national securities exchange later this year. The Texas Stock Exchange aims to attract listings of exchange-traded products and challenge increasing compliance costs at major U.S. indexes, as well as newer rules including setting targets for broad diversity at the NASDAQ, according to a report in the Wall Street Journal on Tuesday. The TXSE will ultimately create more competition around quote activity, liquidity, and transparency, resulting in more consistent and reliable markets, a spokesperson said. And if you're a Texas realtor, this is actually really big news for you. It just means that more and more businesses will be looking to the Lone Star State as a possible location to put down roots, which means more jobs and therefore more people. Big things are coming to Texas, and it's never been a better time to be in real estate than right now, or at least in the near future. Maybe not right now. Now, the U.S. government is spending as if we're in some sort of a global emergency right now. So U.S. government expenditures as a percentage of GDP hit 43%, matching levels not seen since the 2008 financial crisis. To put it in perspective a little bit, spending as a percentage of GDP right now is just 1% below World War II levels. Even at the peak of World War I, U.S. government spending as a percentage of GDP was 20 percentage points lower than what it is right now. You see, propping up the economy with government spending is just one way to maintain growth during an election cycle. But when and how are we going to pay this debt? No one knows or even seems to see this as a big issue, which it should be the number one thing you hear coming out of politicians' mouths on both sides, especially if they care about the health of our country. But right now, it's nothing but crickets from either side of the aisle. So you want to know another reason that interest rates could possibly come down? It's this, because with nearly $35 trillion in debt right now at 5% rates, which is what the Fed charges the federal government to borrow that money, we're going to pay $1.5 trillion in just interest debt in 2025, which is almost 30% of all the government revenue that will be collected next year. This is absolutely not sustainable and is going to be one of the biggest threats to the overall U.S. economy that you're going to hear more and more about in the coming years. Also, right now, the gap between native-born and foreign-born employment has never been wider. U.S. native-born employment has not seen any growth since 2020. But at the same time, the foreign-born workforce has seen a 14% growth. Immigrant employment jumped from 27.1 million in January of 2020 to almost 31 million in May of 2024. Meanwhile, the full-time job count fell by 625,000 jobs, while part-time employment jumped 286,000 in May. Right now, labor market dynamics are shifting to part-time employment and cheaper labor from foreign-born workers. The only wage growth that's happening right now is at the lowest levels of the economy and also at the highest levels, meaning the poorest and richest are seeing the most growth. But remember, it's all relative. Meanwhile, everyone in between is experiencing higher and higher prices for everything because more demand from more people and also stagnant wages. And they wonder why half of the American public think that we're currently in a recession. This is just one more reason why we are sitting in a housing affordability crisis, because the middle class is slowly slipping away. But in tech news, Apple and OpenAI, creators of ChatGPT, just announced a new partnership that will include ChatGPT being integrated to many Apple devices coming down the pipe. Apple Intelligence, as they're calling it, will be available on iPhone 15 Pro and Max, plus iPads with the M1 operating software and later. So why should you care about this? Well, if AI isn't already a big part of how you run your real estate business, then it better start to be, because there is absolutely no tool on the planet that's going to have a bigger impact on you personally over the next 10 years than AI. And its integration into everything that we do is already here, and it's moving at an exponential rate. So you better get very familiar with it if you already aren't, because it isn't coming, it's here. And if you're not up to speed, you're already late to the game. All right, now for our final story of the day. So what do an FBI raid, a software algorithm, and your prospective buyer's current rent payment all have in common? Well, it's a big real estate antitrust case. And good news is it has nothing to do with your commissions for a change. But it does involve what I like to call the Skynet of real estate and this little company called RealPage. Now, if you've been following this show for the last year, you would be very familiar with these scumbags. Now, I want to give a shout out to one of my favorite online news sources, which is called Breaking Points, and their correspondent, Matt Stoller, for putting this wonderful story on my radar. Breaking Points is a wonderfully balanced news show that you can find on YouTube, and I highly recommend you check it out. It's something I watch almost every day. So on June 4th, they ran a story from Matt Stoller about an FBI raid of a big corporate landlord over algorithmic price fixing. So Cortland Management, an Atlanta-based firm that rents out 85,000 units across the US, had their headquarters raided by the FBI last week. Now, this particular raid was part of a much bigger conspiracy orchestrated by software and consulting firm RealPage to increase rents nationwide by coordinating landlord pricing decisions and holding empty apartments off the market in order to shrink available supply. So right now, 81% of apartments located in Atlanta are owned by Cortland, and for the last several years have had their rental rates set via this RealPage software. And as a result of this, rents in the Atlanta metro area have grown by 80% since 2016. Yes, 80%. So you see how this happens is that RealPage goes into a market like Atlanta, and they contract with all of the landlords in the area and share all of the pricing and inventory data available. And based on that data, generate rent amounts that all of these units should be set at. And what this does is it allows for all of the landlords in a market dominated by this RealPage algorithm to offer the same or similar rent based on the size and location of the apartment or home. So then when the time comes to raise the rents, the landlords can raise it by the same percentage across the board. So as a tenant, if you're looking for a cheaper place to live, you don't have any options because the rent is the same. And the real kicker of this is that they would tell apartments in multi-unit properties to keep certain units off the market so they weren't available in the active supply. And they would do this to help drive the overall rents of the units available up. So overall, in the aggregate, they would make more money for the landlords. And by the way, this is happening to some degree in markets all over the country right now. Heck, even here locally, the Fort Worth Star-Telegram reported last week that 26% of the homes in Fort Worth were owned by large corporations. And if you think these companies aren't using similar softwares to set these rent prices, then you need to think again. Now, the good news at least is it looks like they're cracking down on this, as demonstrated by this most recent FBI raid. But what it doesn't mean is that this problem is going away. If anything, they're just going to get smarter about how they do this and avoid the scrutiny of the law, because that's what happens with everything, especially when it comes to big money. But the bigger takeaway from this, especially as real estate professionals, is that this is what happens when you rent. You have zero control in the cost of your housing. And whether it be a landlord, a big corporation, or a computer algorithm, someone or something else is determining what you have to pay to live. And even though right now the cost to own your home and the rates to obtain financing are at the most unaffordable levels in history, how is it possible to see this story and not understand that renting as a long-term solution is not affordable or sustainable either? Look, mortgage rates are going to fluctuate every single year. Sometimes they're up, sometimes they're down. And home prices are going to continue to climb no matter what the rate environment. And it's true, right now it is cheaper to rent than it is to buy. But having absolutely no control over your housing cost and leaving it into the hands of someone else is not the answer either. You see, this algorithmic pricing trend is like how Netflix and Amazon know what you're shopping for and what you like. They're all using the same data. So they're going to know how much money you make and based on your zip code, what you'd be willing to spend. And then they use the algorithm to set those prices accordingly. Heck, even Wendy's, the burger chain, tried to float the idea of how to price their food based on this. They were going to use algorithmic pricing to adjust the pricing based on the time of day, the market, and what part of their menu that people like the most. And when they did this, people lost their minds and they canceled, at least for now. But this kind of algorithmic pricing is coming no matter what we do. And it's just a matter of time before it starts to take over everything, including your rent. So if you need another reason to help your buyers understand the importance of owning a home and not renting forever, well, here you go. This is the real antitrust case that actually matters, not the one related to your commissions. So share this with your network. Let them know about all the things that are conspiring against them to take home ownership away, and urge them to fight back by not letting this stuff happen. And the number one way to do this is to control your own housing expense before someone else does, and to start taking those first steps to becoming a homeowner, whether that's education, talking to a lender, or starting to shop for homes. Information is the key to alleviate the fear of buying. And your job is to arm them with this information so they know what the future might look like if they stay a renter. Because like I've always said, the best time to buy was yesterday, but the second best time to buy is right now. Well, my friends, that is all for today. Hopefully you walked away with a little bit of ammunition to get your buyers and sellers in the right headspace about today's market and the opportunities that are available. My intent is to bring you information to help you do more business and show more people the path to that American dream that we all strive for. So until next time, be great humans, keep grinding. Because life is what you make, so make it great. Have a great rest of your week.